Ever wondered how businesses keep track of their financial health? It's a lot like maintaining your own physical health. You need balance. And in the world of business, that balance is achieved through something called the accounting equation. Now, what is this accounting equation, you ask? Picture a perfectly balanced scale. On one end, we have assets, which are all the resources a company owns. On the other end, we have liabilities and owner's equity. Liabilities are what the company owes, and owner's equity represents the owner's investment in the business. Just like a balanced scale, the total assets must always equal the total liabilities plus owner's equity. This equilibrium helps businesses maintain their financial health, providing a clear picture of where they stand at any given time. By the end of this video, you'll understand how these three components interact to provide a snapshot of a company's financial position. So, what exactly are assets in the context of the accounting equation? Well, if you imagine a business as a ship, assets are the wind in its sails. They are the resources a business owns, resources that hold value and can be converted into cash. Assets are the lifeblood of any business operation, fueling growth and paving the way to prosperity. Now, assets can be categorized into two main types, current and non-current. Let's delve a little deeper into these types, shall we? First up, current assets. These are assets that a company expects to convert to cash or use up within 1 year. They're the most liquid assets, meaning they can be quickly turned into cash or are already in cash form. Examples of current assets include cash itself, accounts receivable, inventory, and short-term investments. Think of current assets as the sprinters in the financial race, quick, agile, and ready to be used at a moment's notice. On the other hand, we have non-current assets. These are long-term investments that a business can't easily convert to cash within a year. These include tangible assets like property, plant, and equipment, and intangible assets like patents, copyrights, and goodwill. Non-current assets are the marathon runners of the business world. They might take longer to show their value, but they offer sustained benefits over time. So, why are assets so crucial? Well, they represent the economic resources a company has at its disposal. They are what a company uses to produce the goods or services that it will sell to its customers. The value of a company's assets, both current and non-current, can tell us a lot about its financial health and its ability to weather economic storms. By understanding assets, we begin to see how the accounting equation, assets equals liabilities plus owner's equity, comes to life. Assets are the first piece of this puzzle, the starting point of our journey into the heart of accounting. With this understanding of assets, we are one step closer to fully grasping the accounting equation. Now, let's dive into the world of liabilities. Liabilities, a term that might sound ominous, but it's simply a part of doing business. In essence, they represent what a business owes to others. Just as assets are what a business owns, liabilities are the obligations that it needs to fulfill. Picture it like this. You're hosting a grand party. You've ordered the finest catering, and the bill comes due after the event. That bill, that's a liability. It's something you're obligated to pay, a debt that you owe. But not all liabilities are created equal. There are two main types, current and non-current. Current liabilities are those due within a short-term period, typically within a year. These might include accounts payable, accrued expenses, and short-term loans. Consider them as the everyday obligations, the costs that keep the business running smoothly. On the other hand, non-current liabilities are the long-term obligations, the debts that are due over a period longer than 1 year. Think of them as the big-ticket items, like long-term loans, bonds payable, or deferred tax liabilities. They're like the mortgage on a house, not something you can pay off immediately, but rather over an extended period. So why are liabilities important? Well, they give a clearer picture of a company's financial health. Too many liabilities could mean a company is over-leveraged, potentially leading to financial instability. But some liabilities are necessary for growth, enabling businesses to invest in assets that generate profits. It's crucial to remember, though, that liabilities are not inherently bad. They're simply a part of the financial landscape, a necessary component in the intricate dance of business finance. Without them, many businesses wouldn't be able to operate or expand. Now, with this newfound understanding of liabilities, the accounting equation starts to make more sense. Assets are what a business owns, liabilities are what it owes, and the difference between the two is the owner's equity. Now that we have demystified liabilities, the accounting equation starts to make more sense. Finally, let's tackle the last piece of the puzzle, owner's equity. Now, this is the part of the accounting equation that represents the owner's claim on the assets of the business. Think of it as the residual interest in the assets of the business after deducting liabilities. In simpler terms, it's what's left over for the owner once all the debts have been paid. Owner's equity is crucial to understanding the financial health of a business. It gives a snapshot of what the business owes to its owners. The more equity a business has, the more financial stability it enjoys. But how does owner's equity change? Well, it's a dynamic figure, not a static one. It changes with the ebb and flow of a business's financial activities. When a business earns profits, these profits increase owner's equity. That's because profits represent an increase in assets without a corresponding increase in liabilities. In essence, they increase the residual claim of the owners on the business assets. Conversely, when a business suffers losses, these losses decrease owner's equity. That's because losses represent a decrease in assets without a corresponding decrease in liabilities. In other words, they erode the residual claim of the owners on the business assets. Owner's equity can also change with owner withdrawals. If an owner withdraws funds from the business for personal use, this decreases owner's equity. That's because it represents a decrease in assets without a corresponding decrease in liabilities. It's like the owner taking a piece of the pie away, reducing the size of the pie that's left. So, in a nutshell, owner's equity is a reflection of the financial state of a business from the owner's perspective. It's the part of the pie that the owner can claim once all the debts have been paid. It's a measure of financial strength and stability, changing with business profits, losses, and owner withdrawals. With an understanding of owner's equity, we now have all the pieces of the accounting equation. So how do these three components, assets, liabilities, and owner's equity, fit together? Think of it like a balancing act. On one side, we have assets, everything a company owns of value. This includes cash, inventory, property, and more. On the other side, we have liabilities and owner's equity. Liabilities represent what the company owes, like loans or accounts payable. Owner's equity, meanwhile, is the value that belongs to the owners after all debts have been paid. It's the residual interest in the assets of the entity after deducting liabilities. When you add up the liabilities and the owner's equity, it should equal the total assets. This is the accounting equation. Assets equals liabilities plus owner's equity. This equation is the cornerstone of double-entry bookkeeping, ensuring that a company's financial reports always balance out. And there you have it, the accounting equation, a fundamental concept that keeps the financial world in balance.